Hello everyone. Welcome to this session on law relating to banking companies in India. In this lesson, we will understand what banking is, what a banking company means, the role of the Reserve Bank of India, and the important legal provisions governing banks in India. Introduction. Banks play a very important role in our daily lives and in the economy of the country. Whenever people save money, take loans, transfer funds, or make digital payments, they are using banking services. Banks collect money from people who have savings and lend it to people and businesses who need money. To ensure that banks function properly and safely, the government has enacted several laws. The most important law governing banking companies is the Banking Regulation Act, 1949. Along with this act, the Reserve Bank of India Act, 1934 also plays a major role in regulating banks. Meaning of banking. Let us first understand the meaning of banking. According to Section 5B of the Banking Regulation Act, 1949, banking means accepting deposits of money from the public for the purpose of lending or investment. These deposits must be repayable on demand or after a specified period. Customers should also be able to withdraw money through checks, drafts, or other methods. Banking company. Now let us understand what a banking company is. According to Section 5C of the Banking Regulation Act, a banking company is a company that carries on the business of banking in India. In simple terms, any company whose main activity is banking can be called a banking company. These institutions accept deposits, provide loans, and offer various financial services to customers. Objectives of banking regulation. Why do we need laws to regulate banks? Banks deal with money belonging to the public. Therefore, strict regulation is necessary. The main objectives of banking regulation are to protect depositors' money, to maintain confidence in the banking system, to ensure that banks operate safely and responsibly, to prevent misuse of public funds, and to maintain financial stability in the country. Without proper regulation, the failure of banks can affect millions of people. Business permitted to banking companies. Section 6 of the Banking Regulation Act specifies the activities that banking companies are allowed to undertake. Banks can borrow and lend money. They can deal with bills of exchange and negotiable instruments. They can issue letters of credit. They can provide safe custody services. They can undertake foreign exchange transactions. They may also act as agents for customers and businesses. These activities support the smooth functioning of the financial system. Business prohibited for banking companies. While banks are allowed to perform several activities, there are also restrictions. According to Section 8 of the Banking Regulation Act, banking companies are generally prohibited from directly engaging in trading activities. For example, a bank cannot start buying and selling goods as a regular commercial business. The reason for this restriction is to ensure that banks focus on banking operations and do not expose depositors' money to unnecessary risks. Licensing of banks. Before starting banking operations, every banking company must obtain a license from the Reserve Bank of India. This requirement is provided under Section 22 of the Banking Regulation Act. While granting a license, RBI examines various factors. These include the financial position of the bank, adequacy of capital, competence of management, public interest, and future prospects. Only after satisfying these conditions does RBI permit a company to conduct banking business. Capital and reserve requirements. Banks must maintain sufficient capital and reserves. Capital acts as a financial cushion and helps banks absorb losses during difficult situations. Adequate reserves ensure that banks remain financially strong and capable of meeting their obligations to customers. These requirements improve confidence in the banking system and help maintain stability. Reserve Fund. Section 17 of the Banking Regulation Act requires every banking company to transfer at least 20% of its annual profits to a reserve fund before declaring dividends. This reserve fund strengthens the financial position of the bank. It provides protection against future losses and unexpected financial difficulties. In simple terms, banks must save a portion of their profits for future security. CRR and SLR. Two important concepts in banking regulation are cash reserve ratio, commonly called CR, and statutory liquidity ratio, known as SLR. CRR is the percentage of deposits that banks must keep with the Reserve Bank of India. SLR is the percentage of deposits that banks must maintain in liquid assets such as cash, gold, or approved government securities. These requirements ensure that banks have enough funds to meet customer withdrawals and maintain financial discipline. Management of banking companies. The Banking Regulation Act contains provisions relating to the management of banks. The law regulates the appointment of directors and senior management personnel. Good governance is essential because poor management can affect the safety of depositors' money. RBI has the power to issue directions and take action if the management of a bank acts against public interest or financial stability. Inspection of banks. The Reserve Bank of India has the authority to inspect banks regularly. During inspections, RBI examines the financial condition of banks, lending practices, compliance with laws, and overall management efficiency. The purpose of these inspections is to identify problems at an early stage and ensure that banks operate in a safe and sound manner. Amalgamation means the merger of one bank with another. Bank mergers may take place to strengthen financial stability, improve efficiency, or protect depositors. When a weaker bank faces difficulties, it may be merged with a stronger bank. Such mergers help maintain confidence in the banking system and prevent disruption to customers. Moratorium and reconstruction. Sometimes a bank may face serious financial problems. In such situations, RBI may recommend a moratorium. A moratorium temporarily restricts certain banking operations to prevent further financial deterioration. A reconstruction scheme may also be prepared to revive the bank and protect depositors. The ultimate goal is to restore the bank's financial health and safeguard public interest. Winding up of banking companies. When a bank becomes insolvent or is unable to continue its operations, it may be wound up according to law. Winding up means the legal process of closing a bank and settling its liabilities. This may happen due to insolvency, serious violations of banking laws, or unsafe banking practices. The process is carefully regulated to protect the interests of depositors and creditors. Role of RBI. The Reserve Bank of India is the central bank of the country. It plays a crucial role in regulating and supervising banks. RBI grants licenses, conducts inspections, issues directions, controls credit, and oversees the overall banking system. It also acts as the banker to the government and banker to other banks. Because of these responsibilities, RBI is often called the guardian of India's banking system. Deposit insurance. To protect depositors, India has a deposit insurance system administered by the Deposit Insurance and Credit Guarantee Corporation, or DICGC. If a bank fails, eligible deposits are protected up to the limit prescribed by law. This system increases public confidence and reduces panic during financial crises. It provides an important safety net for small depositors. Banker-customer relationship. The relationship between a banker and a customer can take different legal forms. The most common relationship is that of debtor and creditor. When a customer deposits money, the bank becomes the debtor and the customer becomes the creditor. Banks may also act as agents when collecting checks or making payments on behalf of customers. In some situations, banks may act as trustees when handling funds in a fiduciary capacity. Modern banking developments. Banking has changed significantly in recent years. Today, customers use internet banking, mobile banking, UPI, and digital payment systems for everyday transactions. These developments have made banking more accessible to millions of people across India. Conclusion. We have now completed our discussion on the law relating to banking companies in India. Understanding banking laws is important because banks play a critical role in the economy and affect the financial lives of individuals, businesses, and governments. Thank you for joining this session.